Welcome to this new episode of Your Next Trade called today Not a Likely Outcome, Powell. We're going to be looking at why the Fed and why Powell has been moving the market so big this week. But I want to flag as a teaser that for the technical analysis, we're going to be looking at only three charts. So three charts that I think are very important for the market looking forward. So if you get a bit of time, you should be jumping and really looking at this technical analysis because it's a good tell of what could happen next. So in terms of week-to-date asset performances, what has been interesting for the week is we've seen that equities have been pretty strong, so 1%. So only 1%, it feels a bit like weakish, but actually we started the week a bit weak, where we went down 1 to 2%, breaking the 4,000 level. And on Wednesday, starting 6:30 for the UK time, 1:30 New York time, the FOMC through the Fed Powell made the speech and saying, everything is fine, and the market rallied on that. Not only stocks, but actually across asset classes, we had a risk on market where the US dollar weakened. So it's down 1% overall on the week. So it's overall like the equity market. So if you look actually at the Euro stocks has been underperforming a bit. So Europe has underperforming a bit US. Based if you look on the euro terms, but if you look in dollar terms, actually this is more or less the same. So something that I mentioned last week, interestingly, a lot of investors are scratching their heads and saying, you look at Europe has been very strong. Yes, Europe has been catching up, but in dollar terms, the performance between the S&P 500 and the Stock 600 is more or less the same for the year. Still, that could be a bit surprising for some, but that is the reality. All the assets have been moving almost with a one correlation and moving the same way, Europe or US, and across asset classes. A bit of bonds for the crypto world. So we are up 3% for Bitcoin and 8% for Ethereum. I'm not going to be talking about FTX making the headlines. If you don't have much time and you really don't want to be trading the market, spend hours and hours watching this guy on FTX. There's absolutely no point. This is just a joke. And we know the outcome, and we know where this guy is going to end up. WTI, small up, and we get the OPEC meeting this weekend, where they're going to be making a decision. It seems that there's going to be no change position, maybe a small cut, but it feels like a no change. Why as well? Because the China seems to be reopening a bit, and the COVID rules are not going to be as strong as they be in the past, for a big reason, which is the Chinese economy is really slowing. You get social unrest, and they have to reopen the economy no matter what. So commodities pretty strong on the week. WTI, copper, luxury stocks in Europe, the names of LVMH, Kering, Hermes were really strong on the reopening of China. If you look at the week-to-date performances, what is interesting, if you look at the S&P, which is here, there is a lot of dispersion between the winners and the losers. So everything on the global scale has been moving up, but there has been dispersion between the big winners, as we can see here, the social media, online retail, gaming, and some of the miners have been doing pretty well. But we are quite far away from the 1-2% from the S&P. So 1% here, and you see there is a big chunk of the market that has been moving quite a lot. And very often when we get a risk on, so that is the case for this week, what happens is the US dollar is coming down and negative for the week. So no surprise here. What you can see as well is the banks have been struggling in the US and in Europe, struggling not that much, but they have been underperforming the market. Why is it so? Because when yields are coming down the way they have been down, so the US 10 years, which 6 weeks ago was at 4.4%, closed the week at 3.5%. So that means for the banks, there is a strong correlation between where the yields and where how they are making money. So if you look at the correlation between, for instance, if you look at Europe, between the Bund and how the stock 600 bank would be doing, when yields are going up, normally the banks will be making more money because based on their books, and this is why the banks will be outperforming. This week, what has been interesting is based on the weakness of the strength of the bonds and the yields going lower, banks have been underperforming the market. So we're going to see later on if we're going to have some follow-up. But again, this is very much a market of strong correlation. For the rates, so the US 10 years, 3.5%. So look at the picture. We're going back into the level that we had in May. You can't be really making technical analysis on yields, but that gives you the moves that we had recently where we overshoot, and it's easy to say overshoot afterwards in hindsight, where we overshoot at 430, 440, and since then we have been coming down. What is interesting is the US 10 years is at 3.5% versus the Fed fund rates that are at 5%. So there is really a big gap between the short-term yields and the long-term yields, which we can see here with the yield curve that is really quite inverted, down and quite inverted. The quite is an understatement. We are down 80 bips, negative 80 bips, which, as you know already, is very much a good leading indicator for recession coming. What has been interesting from the meeting, from the interview done by Powell, is he has trying to say that maybe, and he's hoping to have a soft landing, and as we're going to see, the odds historically are going against him. Looking at the euro dollar and what are the Fed expectations, so the terminal rate, which is the peak of the rates, is June 2023, is very much the same. What happened between this Friday and the Friday before, so Friday a week ago was the 25th, so that's in red here, and the blue, you see that the market is expecting the Fed to be a bit less hawkish, so a bit more dovish, more accommodative than it was a week ago. So based on the meeting on last Wednesday with the Fed and afterwards, the whole yield curve moved a bit. So if you add all the moves all together, we are talking 25 bips to 50 bips changes. Accommodative, but still, we are, if you think about the numbers, 3.5% on the US 10 years, and we are expecting the Fed fund rates to be around 5% in, so if you do 100 minus this number, that gives you 5%, 5.10% into June next year. So as I said before, if you are an investor, you're looking 3 to 6 months. A lot of this has been priced in. We knew when the market will be normally peaking, and we're going to be talking later on the TAP 6 week this week what has been happening. VIX really interesting. Now we are going into 19% level, so we broke the 20% level. I don't think if there is any significant out of it, but 19% for the VIX is the historical average since its creation in 1991. Okay, so if you look at the implied volatility of the S&P 500 these days, or at least at the close of Friday, we are at a level that is historically an average. Okay, so based on that, based on your macro and where you see the market, there might be a trade. What I found interesting over the last 2 to 3 weeks, as I've been saying, as it is coming into the low 20s and now into the high 10s, I think it's interesting if you are looking at hedging your portfolio, taking some direction, obviously, to go long some of the premium. What happens very often is, if you look at 2017, when the market, when the volatility comes down, those are for good reason. Okay, now we get a big question mark. Is it going to be the same as April? Is it going to be the same as the rally that we had this summer that ended up mid-August? And then the correlation is obviously when vol goes up or when the market is selling off, vol goes up. In terms of the VIX structure, this is normal, more or less normal VIX structure. So I want to go into some technical analysis, what I call always some dodgy technical analysis. I want to be looking at 3 charts today, no more than that. The first thing that I've been flagging, and if you look on Twitter, everyone is looking at this chart, which is here we are taking the S&P 500 through the S&P futures, so the futures, and you see this trend that started in December. We have been testing this week this trend. Okay, so almost 41.10. So the level was between 41.05 and 41.10. So in hindsight, again, this is easy. We broke the 200 moving average, but so far we managed to go below. My impression, as we don't have much of catalyst going forward, and more importantly, there is a big position of JP Morgan. So JP Morgan is using through one of their funds a lot of calls and a lot of puts, and one of their big position, I think, is a call at 41.45. So naturally, the more you get close, you're getting closer to the biggest expiry, which is on the 3rd Friday of December. There is a natural magnet to go into those big levels, and this big level is 41.45, which tells me that the odds of breaking this 4100 is higher than usual, especially as everyone, is it a good thing to be everyone, but that we could have like another 2, 3, 4% on the market rally. So if you look at what has been happening coming back into the VIX just before, is volatility has been dying. Why? Because for the next 10 days there is no catalyst. Okay, no catalyst, no real thing to be looking at. So the trend is still your friend, with not necessarily a lot of conviction, but money is still coming into the market. So this rally is very much hated by many market participants because they missed it, because they had a bad year. But still, if you are long only, you need to follow these things. So this is the first chart really to be looking at. You don't need to be looking at all the other asset classes. They are all moving the same. So when people are telling me, look, I'm trading the bonds, I'm trading the euro dollar, I'm trading the dollar yen, reality is beta adjusted. Almost everything is moving the same. So look at this chart. If it's breaking higher, you know that all your other assets will be moving the same. A second chart that I think is really, really important, and now I'm going to be moving on the weekly chart. It's the XLI, which is the industrials versus the S&P. So if you look at this chart, why is it important? For me as a trader, I don't pretend to be a macro guy and to be very, very smart and know everything. But if I look at some charts, that will tell me the underlying story. So XLI is obviously industrial. And if I look at industrial versus the S&P, that gives me a lot of understanding of what is the economic cycle, the industrial economic cycle. So if you look at the long-term cycle that started after the GFC in 2009, the XLI then have been moving into a smaller term cycle. So we are talking 2 years or 3 years. So we had the scare in 2012, then we had the scare in 2015, 2016, which was mostly about China and how China will be slowing. Then obviously we get the COVID, and since then we have been trading below this 0.25 XLI versus the SPY. Now what has been happening, we have been testing recently this level based on the fact that some market participants and more market participants are expecting a soft landing of the US economy. And as well, there is the case of many companies in the US and in Europe are reshoring their businesses from China, from Asia, into the mainland. So that means if you have been producing, and I think Apple is making the headlines today that Apple is going to be moving some of their businesses from China into Vietnam, and I think it's going to be as well Europe. So that means it benefits your own industries. But now the tale is, if you really want to have another growing cycle, you need industrial to be moving above this 0.25. Again, this is dodgy technical analysis, and maybe some guys will say, oh, that is absolutely nonsense. It works pretty well to understand the cycle. So my second chart is really looking at XLI versus the S&P, and how XLI could even more outperform the S&P. And I have many questions coming, a lot of people coming to me and say, I want to be short the XLI. As long as the chart looks this way, I won't be doing much. Finally, something that I mentioned in one of my tweets this weekend is I'm looking at I'm always looking to identify the winners and the losers of any market. So what you want to try to identify when you're a trader is really stocks that are going up, that are outperforming the market. So the winners will be outperforming the markets, and that could be on a one-day time frame, 1 week, 1 month, 2 months, 6 months. What we know is since 2015, 2016, if we look at all the FANG of this world, so we are talking Facebook, Meta, Amazon, Apple, Microsoft, Google, Nvidia, and Tesla, it was outperforming the market. So we knew that what happened before is the market was mostly driven by this 20 to 30% of the S&P. So this 20 to 30% of the S&P were going higher and the whole market was moving. Now, since the highs that we had last year in around October, November, those names have been underperforming the market and the market has been struggling to find new leaders. So if you take this level of those 6, 7 generals, which are the names that I mentioned, and you put them back into the levels that we had 3 months ago when the market rallied, actually the S&P, as I said in one of my tweets, should be 4 to 5% higher. So instead of having the market at 4,100, we should have the market at 4,300. So if you were thinking that the rally was overextended in August, that is exactly the same these days. The question now is, are those names going to carry on underperforming? If you give me a chart like this, it feels very much like they will. And as well, if we want the market, and I'm talking S&P, I'm talking Nasdaq, I'm talking Russell, if we want the market to move higher, what could be the stocks, what could be the leaders, the sectors, the industry that could push the market higher? For the time being, we have been talking mostly about, sectors, industry that have been bouncing, that, short covering, but no real drivers. So that is obviously the challenge for your ID generation going into 2023. So now going back into what happened this week, it's a bit of hindsight and looking backwards, but it started with, as we said before, that the week really started on Wednesday in terms of catalyst, with Powell talking at the end of the afternoon in UK time and start of the afternoon in the US. So he said mostly two things. He said that he wants the Fed to be taking a bit of a breather in terms of hiking rates. Why? The biggest reason is they want to evaluate how their hiking cycle is affecting inflation. So, and they are scared of doing too much, and more importantly, to make sure that they can readjust. So that means they're probably gonna do 50 bips in a rate hike in December. More importantly, that means that for the next 3 to 6 months, they're gonna really slow down the hiking. And the second thing that I found very interesting, and maybe you should pause now the video and reading those words from the Fed chairman, is literally they have been saying he knows that if you look at history, the odds are going against the Fed. So the call of the market and why the Powell was so happy on Wednesday is the odds of not a hard slowdown, not a hard landing, are really coming down. He's hoping and he's feeling more and more like the market that a soft landing is coming. If you look at the odds, if you look at history, if you look at such an inversion of the yield curve, if you look at inflation being so high, the odds are very, very low that we're only going to have a soft landing. So for the time being, it's kind of a smiling FOMC and Fed. There is huge question mark. If you look at how the market has been behaving, and I put here the S&P versus the 10 years, as I said before, and you know that if you've been following the videos or trading the market, is the correlation between assets is very much one. So if you trade the S&P, or if you trade the T-note, or if you trade the euro dollar, the dollar yen, we all gonna have a different product, but they are more or less the same. And you see here the correlation between the S&P 500 futures, the ES versus the T-notes, which is 1. Okay, and I'm talking over the last 5 days. The second point of the week, which was on Thursday, the PCE inflation, it was in line to a bit better. We know. So if we look at this chart here, that the PCE year on year is at a very high level, so it's way above the 2% target of the Fed. But as well, we know that there is a kind of a plateau. It's reaching a ceiling, should I say, ceiling, and now that was confirmed with the ISM manufacturing prices numbers. We know that is probably high. There is still concern based on the NFP number that there is still wage inflation. So the wage inflation on yesterday was not great. So this is why I think the market started to sell off, then came back a lot. And finally, in terms of leading indicator going forward, the ISM manufacturing. So I dig more into the numbers. To me, this ISM manufacturing is really bad. So the headline is only 49%, which tells you, okay, we are going into recession. So you think it's not the end of the world. But if you look at the new orders, which are coming down to the 47% level, what is more worrying is the numbers of sectors. So if you take the 18 sectors of the ISM manufacturings, only one was in growing phase in November 2022 versus 14 that were in recession. So you do have like more and more industries that are coming into recessions, and don't forget that the new orders are your leading indicator of your leading indicator. So in other words, if we carry on with that pace of slowing down, the odds as well of having a soft landing are getting smaller and smaller. So at the moment, there is a fight between soft landing and hard landing. So in terms of catalysts going forward for this week, so we get the ISM services on Monday. Okay, so this is unfortunately the biggest catalyst of the week. So for your ID generation, that could be helpful. There is no Fed speakers because the Fed is in blackout period until FOMC meeting. So the FOMC meeting is on the 14th. So that is your biggest catalyst with the CPI on the 13th. So we'll have to wait another 10 days for the market to be more active. And if you look at the implied volatility on a daily basis using your S&P daily options, you will see that volatility is pretty low until the 13 and 14 when there is a spike. And then 2 days after the 14th, you get the biggest expiry of the year, which is on the Friday the 16th. In between, so the straddle, sorry, that was for last week, so I didn't check what was the straddle for this week for the S&P, but that's something that you should be checking. So another catalyst, the natural catalyst that you're going to have, that you see here, the earnings season is over. You're only going to have still some big names like Costco, Oracle that are coming with their earnings, but mostly what you have is the conferences from companies. So they will tell you how the business is doing. So we'll see if the climate has been deteriorating further between now and and 3 weeks or 4 weeks ago. If you look at the Chicago PMI came out at 37%. This is a strong leading indicator for the ISM manufacturing, and the picture is not great. So based on that, we had the VIX at 20%. If you look at the 20% that you had here and here, again, each time the market, when we were around the 19%, 20%, we had a bit of rally of the VIX and the market selling off again. Going into 2023 and the catalyst, which I think is the most important thing, is it's about always looking into the correlation. So this is the chart here between the S&P, the correlation between the S&P and the earnings. So for the S&P to grow, you need earnings to grow, and so in white you get the S&P, and in blue you get the earnings. What has been happening so far is for 2022 earnings have been pretty much okay until Q3, Q4, where there have been some slowdown, and actually the expectation for 2023 have been coming down. So the S&P has been mostly coming down on multiple compression. So if you look at the S&P, you take a level which will be, let's say these days, $200 or $220 of S&P earnings, and you multiply that by your multiple, and that gives you a level for the S&P. So if you take these days, let's say 210 for the S&P earnings, that you multiply by 20, you're going to have 4,200 on the S&P. Okay, so that's the level of the S&P. So what has been happening is earnings have been pretty much okay, still earnings growth, but the multiples have been coming down. So instead of having a 23, 24, 25 times multiples, which gives you a 4,600, 4,800 on the S&P, the market participants have been saying, okay, we use 20%, 20 times. Why? Because yields have been on the way up. Now the question for 2023, the most important things will be earnings, and how these earnings could, on the versus the economy slowing, still be that strong. So as always, you start the year and you make two assumptions. What is your multiple, which is a tricky one, and where are your earnings? So earnings really going to be the question for 2023. And here you get two camps at the time, for the time being. You get the soft landing and the hard landing. What the Fed, what Powell has been saying is there is more and more odds. Odds are going that we're going to go into a soft landing, but he's very aware that looking at history, that is normally not what is happening. And against that, you're going to have the hard landing. If you take the hard landing, suddenly your blue line goes way down, and that means you go into the valuation where your S&P go into the 3,000, 3,300. So that is very much what the catalyst, not much for the next 10 days, unfortunately, and everyone is waiting for the big week, not this week, but the week after. So this is it for me today. If you want to reach me, you can reach me and sending me an email if you get questions. If you want to join us on the trading community, more and more people joining. And I think, it's a nice way to learn and to share ideas. If you want to learn even more, you can have access to the 4x4 video series and or the mentoring, and there is a 25% discount until the 31st of December 2022 using holiday 25 as a coupon. So this is it for me today. See you next week, and if you enjoy what you see, put a like or a comment, that helps. Bye bye.